In 2025, the European Union's pipeline natural gas imports from the Russian Federation collapsed to 6% of the total market share, down from 40% in 2021. The rapid substitution of terrestrial pipeline baseload with globally traded maritime liquefied natural gas dictates a permanent structural reliance on spot market pricing. This severing forced the European Union to expend €335 billion on fossil fuels in 2025 alone, draining domestic capital. Persistent electricity price disparities, with German industrial rates 140% above the global average, are forcing permanent capacity closures in energy-intensive manufacturing sectors. Capital is actively reallocating to jurisdictions with structurally cheaper energy inputs. You are watching Macro Frontier. Macro Frontier. In 2021, the European Union relied on the Russian Federation for 45% of its natural gas imports, equating to roughly 150 billion cubic meters optimized for terrestrial pipeline delivery. By 2025, Eurostat data confirms this physical integration was structurally dismantled, with Russian volumes plummeting over 76% to 36.0 billion cubic meters. The pipeline-specific share evaporated from 40% to a mere 6% of the import market. The mechanism replacing this volume is a total inversion of the supply matrix toward regional allies and maritime logistics. The International Energy Agency reports that Norway expanded production to maximum technical capacity, delivering 89.3 billion cubic meters to capture 30.9% of the European market. Concurrently, United States liquefied natural gas imports surged from 18.9 billion cubic meters in 2021 to 75.6 billion cubic meters by 2025, commanding 26.2% of total imports. This rapid geographic reallocation of supply chains neutralizes legacy geopolitical dependencies, but instantly exposes the European electrical grid to the logistical friction of global maritime trade. The consequence is a permanently altered baseline for energy security, requiring persistent baseline overbidding against Asian markets to secure flexible cargoes. The systemic reliance on liquefied natural gas introduces acute structural fragility and unprecedented price volatility. By elevating liquefied natural gas to over 41% of its total gas supply in 2025, up from 22% 4 years prior, the European market is now permanently tethered to the Asian pricing premium. The European Union Agency for the Cooperation of Energy Regulators explicitly models this vulnerability, projecting that a hypothetical closure of the Strait of Hormuz in 2026 would subject the global market to an immediate 27 billion cubic meter net supply shortfall. The transmission mechanism here is purely competitive. A supply shock instantly triggers a bidding war between European and Asian buyers, forcing severe administrative rationing and heavy industrial shutdowns across the eurozone. Furthermore, emerging regulatory friction threatens this new equilibrium. The United States Department of Energy and allied exporters have formally warned that the extraterritorial application of impending European methane emissions measuring regulations could render a massive portion of current imports technically non-compliant by 2030. The consequence is an artificially induced supply contraction, engineered precisely when dependence on foreign maritime extraction is absolute. The transition to a maritime-centric energy network necessitated the fastest infrastructural mobilization in European industrial history, bypassing decades of traditional permitting. Between 2022 and 2025, data from Gas Infrastructure Europe indicates the bloc expanded its total regasification capacity by roughly 1/3, adding between 50 and 70 billion cubic meters. This rapid deployment of floating storage and regasification units elevated total import capacity to 235 billion cubic meters, theoretically capable of supplying 55% of annual demand. However, the mechanism of emergency leasing has generated severe capital inefficiencies. As structural demand for natural gas plummeted due to industrial capacity destruction and renewable penetration, terminal utilization rates fell from 63% 2022 to 58.5% in 2023. The financial consequence is the rapid accumulation of stranded assets. France entirely decommissioned the Cape Ann floating terminal at Le Havre in 2025 after it sat idle, while Germany terminated its contract for the Energos power unit at Mukran port. Maintaining this surplus infrastructure serves as a mandatory physical insurance policy against spot market shortages, forcing member states to absorb massive operational losses simply to guarantee grid stability. The forced restructuring of the European energy matrix commands a historically unprecedented deployment of capital, fracturing sovereign balance sheets across two conflicting vectors. The International Energy Agency tracks total clean energy investment in the European Union reaching approximately $390 billion in 2025. The investment ratio of renewable generation to unabated fossil fuel power widened dramatically from 6-to-1 a decade ago to 35-to-1 in 2024. Simultaneously, the European Commission's European Grids Package dictates that legacy electricity grids require 1.2 trillion euros in investment by 2040 to manage decentralized renewable inputs. This massive capital expenditure is violently counteracted by the operational hemorrhage required to import physical hydrocarbons. Eurostat reports the European Union expended 335 billion euros strictly on fossil fuels in 2025, effectively transferring domestic wealth to foreign extraction hubs. The transmission mechanism is a compounded capital drag. Industrial and sovereign actors must simultaneously fund a massive, high-interest green transition while paying a structural premium for global spot market energy. The consequence is a severe reduction in available liquidity for research, development, and standard capital improvements across the broader eurozone economy. The foundational crisis facing the European manufacturing sector is a structural disparity in global industrial electricity pricing. The architecture of the European market operates on marginal pricing, meaning the most expensive dispatched unit, currently premium maritime liquefied natural gas, sets the clearing price for the entire grid. The International Energy Agency data confirms that throughout 2024 and 2025, European industrial electricity prices averaged 0.199 euros per kilowatt hour. This creates an unsustainable chasm compared to global competitors. Rates in the United States sit near 0.75 euros, while Chinese industrial rates average roughly 0.082 euros. The pricing anomaly is most severe within the German industrial core, where businesses face baseline costs of 0.240 euros per kilowatt hour. The mechanism driving this peak involves punitive domestic policy choices, including offshore wind levies and grid fees that more than doubled to 1.558 cents per kilowatt hour in 2025 to fund the broader transition. The consequence is a 140% price disadvantage against the global average, mathematically eliminating the competitive viability of energy-intensive European exports in international commodity markets, regardless of internal operational efficiencies. This sustained pricing asymmetry triggered a highly destructive asymmetric shock across the European manufacturing base. Between 2024, energy-intensive sectors including heavy metallurgy and base chemicals experienced a staggering 15% reduction in aggregate output. Because European energy prices surged by nearly 200%, while Chinese inputs increased by a marginal 10%, non-energy-intensive manufacturers bypassed domestic suppliers entirely, importing cheaper intermediate goods directly from Asia. The mechanism of import substitution temporarily masked aggregate industrial declines, but the 2026 disruption of global freight networks through the Strait of Hormuz immediately fractured this reliance. European Central Bank data reflects the ensuing macroeconomic contagion. In May 2026, the S&P Global Flash Eurozone Composite Purchasing Managers Index posted a deeply contractionary 47.5, signaling the sharpest monthly reduction in business activity in 3 years. Input prices re-accelerated due to global shipping bottlenecks, while new industrial orders plummeted. The structural consequence is permanent deindustrialization. Capacity curtailments in the chemical and manufacturing sectors are actively transitioning into permanent plant closures and accelerating capital flight toward North American jurisdictions. The European synchronous grid requires highly stable, dispatchable baseload power to offset the inherent intermittency of wind and solar generation, yet the continent lacks a unified strategy. The German trajectory demonstrates the permanent removal of reliable generation capacity. Following ideological mandates, the final 4.3 gigawatts of zero-carbon nuclear capacity were disconnected in April 2023. While the new federal administration that assumed office in May 2025 initiated overtures to recognize nuclear power within European Union climate legislation, the physical domestic infrastructure was irrevocably shuttered. The mechanism of this phase-out fundamentally altered national grid physics. To balance periods of low renewable generation, Germany transitioned into a net electricity importer, utterly dependent on neighboring production and expensive natural gas peaking plants. This structural reliance on gas-fired generation directly dictates the punitive wholesale prices crushing the domestic manufacturing base. The consequence is a sovereign industrial core that cannot guarantee its own power stability, relying on imported electricity to prevent industrial curtailments, while forcing domestic ratepayers to subsidize the immense grid upgrades required to manage intermittent flows. In stark contrast to the German withdrawal, France maintains a fleet of 56 operable nuclear reactors, actively expanding output to stabilize the broader continental grid. Following severe maintenance disruptions in 2022, optimized management programs facilitated a massive generation rebound. Data from the International Atomic Energy Agency and national operators indicates French nuclear output recovered to 380 terawatt-hours in 2024, representing 67% of total national generation, and maintained a highly robust 373 terawatt-hours through 2025. The mechanism here is load-following capability. Unlike global peers, the French fleet dynamically adjusts output to match fluctuating grid demand, serving as the indispensable baseload anchor for Western Europe. Because the marginal cost of fully depreciated nuclear generation is exceptionally low, France utilizes this surplus to export electricity to structurally disadvantaged neighbors, generating over 3 billion euros in annual revenue. The consequence is a profound geopolitical and economic divergence. By legislating the construction of 6 next-generation reactors by 2050, France is cementing absolute energy independence while establishing itself as the primary beneficiary of the continent's accelerated departure from fossil fuels. The European energy trilemma remains inherently unstable and mathematically unresolvable under current capital deployment models. The 335 billion euros spent annually importing volatile maritime hydrocarbons directly cannibalizes the 695 billion euros required annually to achieve 2030 green transition mandates. The persistent industrial electricity price chasm between the European Union and the United States guarantees the continued erosion of the continent's heavy manufacturing base. Capital will inevitably continue its structural migration toward jurisdictions possessing low-cost, sovereign baseload power. Until deep, cross-border grid integration physically neutralizes the pricing power of the liquefied natural gas spot market, Europe remains permanently exposed to global macroeconomic shocks. This analysis was produced by Macro Frontier. Subscribe for structural macroeconomic intelligence. The data does not care whether you are watching